the key to credit reports and credit ratings is that it's all just raw data. And it's rarely perfect, but usually the imperfections can be tied to something, right? There's always a glimmer of truth that may have been misstated or overstated or whatever. So it's a really, really useful tool for you guys to know how to interpret credit reports, and then also have a layer of sort of knowledge about how to raise scores. So that's what our goal is going to be for today. A, how to read them, but then also where are areas that you can coach somebody on, hey, you know, your credit score could go up. Have you thought about this? And it doesn't mean you're going to be looking at your client's credit reports by any stretch. You're just more of a resource if you can tell them what the #1 reasons why scores are lower than they might otherwise be, which you'll learn today. It also enhances your credibility with that consumer, right? When they realize, hey, not only does Vernon know about Maple Valley houses, he also knows about credit reports and loans and loan approvals, because you learned that last week, you know, all that stuff adds up to, or 2 weeks ago, adds up to a professional, right? So we're going to cover that today. Today's format is going to be more kind of Q&A interactive, so please fire questions all the way along. I've got a PowerPoint presentation that Equifax puts out. We'll go through that, kind of pick pieces of it because it's definitely got some good information, but it's more of a sales kind of pitch for Equifax to solicit our mortgage credit business, right? Because when we were doing a lot of loans, we'd pull 100 credit reports a month. Well, that's a good business. That's valuable to an Equifax or somebody else. So we're going to cover that. But let's start with how to read them, all right? So we're staying here on the obtain loan approval box just for today. After today, we'll be done with that, and we'll move to buyer agency, etc., and we'll continue on down the path. But I wanted to do an extra week here because the big difference for a consumer is the difference between buying a house and not buying a house, right? And a lot of times you may originate a prospect or a lead or a customer and then run into this that puts everything at bay, right? And the uninformed agent views that as a loss. It goes in the loss column. An informed agent, it's just halftime, right? This person still wants to buy a house. And there's nothing more empowering to a consumer than to have a professional that's advising them say, hey, you know what? All this does is change the path. The destination's the same. We're just going to have a plan now. The plan might mean 2 months before you can buy. It could mean 2 years. Depends on what the reasons for the denial are, right? And that's where you would get in close with your loan officer and say, hey, what are we looking at? Do we need to refer them over to Joseph Kidworth and get into credit repair and rehab, or do we just need them to pay down something and then all of a sudden they're approvable? You know, whatever. The credit report can have more influence than simply derogatory items, right? If my Visa card is maxed out, the payment goes up, right? Does that allow me to buy more or less house? Less, right? So if I pay down my Visa card, that improves or increases my pre-approval amount, right? Well, that payment effect can be across 3 or 4 or 10 accounts. So sometimes closing a stupid little Target card that I only opened because I wanted the 10% off when I bought my kid's bike, whatever, fill in the blank, right? The balance is only $400, but the monthly payment is $150. But I only have 2-3 payments left. Shoot, pay off the $400. Now my debt to income just dropped by $150. So your loan officer will be the one that gives that advice, but you need to have an awareness of the cause and effect so that you can have a conversation with them. Hey, have you thought of this? Hey, how much time do you think it takes from when they pay off that hypothetical Target card until their credit report reflects it? Could be up to 30 days, right? So you would want to know that. If you had a closing date that was 10 days away, it would cause you to take different steps. It would cause you to have a different conversation with your loan officer. For example, pays off the Target card. Our closing date is now September 26th. Our closing date is October 10th, let's say. Hey, loan officer, are you going to repull credit? Is that going to happen all fast enough? Would it be smarter for us to pay it off in a certain fashion so that you would have proof that it was paid off, rather than waiting for the credit report to be your proof? Well, you need to have that conversation before they go down to Target and write the check, right? And if you didn't have any awareness of how these things can work, you wouldn't be able to coach your client. And then if they went down and paid it and had no choice but to wait for the credit report to show it, you're not going to make your close date. You're going to have to extend, you're going to risk their earnest money, all the negative stuff starts to kick in. So do you see how this kind of forward posture and awareness of credit helps you, even though you're not a loan officer and you're not counseling them or coaching them? It absolutely comes into play, all right? So we're going to go through all that, and it's going to start with a sample credit report. You would pass one of those back to you, and Diane, I got one for you. All right, so I'm going to have you go to page 2 and turn it sideways. I'll put it up here on the screen. Unfortunately, I copied and pasted it. It came out a little blurry. But what's in your hand isn't so blurry. All right? So this first section is who's pulling it and when they're pulling it, right? The next gray bar, each of these gray bars are what we're going to stop on, okay? So the gray bar delineates a section of the report. So the first gray bar says identification as requested. That as requested means what did you input into the system of your loan officer in order to pull this credit report. So name, social security number, date of birth. That's what it takes to get a credit report. And they want to say as requested because if you transpose numbers or had a typo, there's a good chance the rest of the report might be blank because whatever you transposed isn't a real social security number. They're still going to charge you or charge the loan officer because that's what you requested, right? So that's a little CYA, all right? The next section says residence information. So that's what, again, as you requested, that means that's what this person typed in to pull that credit report, okay? File variations, all right? You should always see 6 file variations when you have co-borrowers, husband and wife. Because there's 3 repositories, right? You see in the left margin, or left column, Equifax, Experian, TransUnion, TransUnion, Equifax, Experian. All right? The blue 3-letter or 3-character acronym, that's also telling you which repository and which borrower, right? BQ1, that's for borrower Equifax 1. BX1, that's borrower Experian 1. BU1, that's borrower TransUnion 1. What do you think the 1 means? If I opened a Macy's card when I was 19, and whatever reason I wrote sloppily, they couldn't read my handwriting, or someone when they entered it in the system got the social security number wrong, I would now have credit under a social security number that was not mine because they transposed the numbers, right? The system would still see that though, and it would go, oh, BX2 is Ed Lane's, one card only shows up under that social security number, but it would show BX2 and it would have a different social security number because I have credit under that number. Does that make sense? Mm. So when I say you should always only see 6, it would be unless there's some mess up in the data, like the example I just gave. Does that make sense?
Question.
Yeah.
Anything with like ID theft, I mean, that's kind of a deal.
That can wreak havoc too.
Right.
Yeah.
Okay.
Yeah. But if the ID theft has your social security number and puts it in correctly, it'll show up under this line. It wouldn't create a second line.
Gotcha.
It may show up with a weird name, right? Like, I never go by Eddie. But if someone stole my identity and happened to use that name, under name variations, and we'll get down to that, Eddie would show up. And then it would be like, oh, okay, who the hell's that?
Gotcha.
Right? Does that make sense?
Yep.
So, with this data, we also have their birth date, right? Robert's is January 23rd, 1951. And Barbara's is August 1st, 1953. If there were discrepancies there, it could create an additional or seventh line like this. This information is useful because later in the report, we're going to see these numbers and letters again, because that's telling us whatever trade line is being reported, where it's being reported.
Gotcha.
Right? So Diane's Nordstrom card Nordstrom might only report to Equifax and TransUnion, not Experian. Well, on her report, it would only say BQ1 and BU1 under the Nordstrom account. And that's useful. Doesn't apply to Diane because her credit's impeccable. But if she had trashed credit, that would tell her where to direct her efforts to clean it up. Okay? All right. Any questions on that variations section? Pretty straightforward, but again, it's raw data, right? All right, this next section, credit score information. What's a good credit score?
830.
What's the highest?
850.
Isn't it
830, 850? 840.
830? The highest 840.
840, yeah. How many people have over 800? Very few. The elite.
Barely.
The top 1%, quite literally, right? So when somebody says, I want to get a perfect score, I've been doing this for 26 years, I've never seen a perfect score. There is no perfect score, right? There's 340 characteristics that go into your credit score. 170 of them say you have too much of this, fill in the blank. The other 170 say you have too little of those same 170 things, because there's a balance, right? Having no credit is a bad thing. Having too much credit is a bad thing. Being perfectly in the middle is not a bad thing. But what's perfect, right? It's almost like DNA. We have multiple trade lines, then you have multiple variables feeding in. You're just never going to have a perfect score. The highest score I've ever seen was under 820. It was like 819. And I've seen, multi-millionaire type credit reports where they didn't owe anybody anything, but yet they had depth of credit, so you couldn't really say they hadn't tried enough, and you can't even tell why they don't have a higher score. But that's the system, right? It's all called FICO scoring. You've heard that term before? Do you know what that stands for?
Fair Isaac scoring.
Fair Isaac Company.
Right?
Yeah, FICO. FICO. So the Fair Isaac Company out of San Jose, California, they invented the credit score. Equifax, Experian, and TransUnion are repositories, so they hold all the data, and then they push the data through the FICO system to produce a score, right? And you'll see they have names for it, right? So look at the first row where it says 696. That's the classic 04 FICO score that TransUnion uses. Experian calls it Fair Isaac version 2, and Equifax calls it Beacon 5, right? That's just branding the FICO score to their own company, okay? What we care about and what the lender and underwriter are going to care about is simply what is the score. As long as it's done through the FICO system, that's what they care about. There are other scoring models out there. None of them are as widely acknowledged and utilized as the FICO score, and that's because it's been around the longest. Now, when you look at a credit score, it will always give you the top 4 reasons that the score is not any higher. Now, it's interesting to me that the first one is a 696, which is a good score, but not a great score, and yet the system couldn't generate what reasons number 3 and 4 were, right? It only gave us 2 reasons. But let's look at the 2 reasons, right? So reason code 040 is for derogatory public record or collection filed, all right? And we're going to, as we go through this, we'll see that collection somewhere, all right? Reason 010, proportion of balance to credit limits is too high on bank revolving or other revolving accounts. When it lists the characteristics, it lists them in the order of significance. So the number 1 reason this score is not higher is a collection or public record. We'll see what it is. Number 2 is the revolving account balances. Everybody with me? That would help me if I were trying to attack and raise the score, because pay off the collection, right? Now, you would have to pay it off, you'd have to let enough time go by that the scores would update, and they don't just happen automatically.
Hello?
They will do what's called a rapid rescore. And so I could contact TransUnion and find out what their documentation requirement is for proof, because it's pretty stringent. They want to make sure you're not just providing a letter that you fraudulently created, right? But they'll say, yeah, send us the canceled check, send us a letter from the creditor saying that the balance is now 0, and we'll push that through so that it updates in the database for a fee. And I haven't done it in a long time, but it used to be $30 per repository, per borrower, per trade line. So if a husband wanted to update one account across all 3 repositories, it'd be $100 or $90. But if it was a joint account, it'd be $180. I've had clients, this goes back many years now, but I've had clients that had student loans that went bad, and the student loans got sold like 7 times. And so she had one loan negatively affecting her times 7, because all 7 people were still reporting it even though it was just the one loan.
Right.
And she had like 5 loans, so it was 35 trade lines. She spent over $5,000 to rapid rescore all this stuff, and is enjoying a home that she bought 10 years ago thanks to that effort. So depends on what you have, it depends on how many resources you have, but that is an opportunity to fix something that would allow your client to buy a house. And it's super effective as long as what they're telling you is true, right? Have you ever had a customer tell you, well, that's not mine, and it actually was? Right? Sometimes that happens. So that's why the repositories say, hey, we need the actual definitive third-party documentation, and then we'll take it off. Okay?
So who would do the credit fix?
So in that scenario, you would go to your loan officer and say, hey, the Joneses said that the student loans are reporting incorrectly and they want to challenge it. Can you do a rapid rescore? And I think now, today, the repositories all have new fancy names for it, but that's what it is. So he'd probably say, oh yeah, it's actually called whatever. But yeah, you would do that through them. So in this case, this is a Kroll factual data, right? That's a company. And we would contact Kroll and say, the Smiths want to challenge this collection, or the Smiths just paid off this collection, we'd like to get it updated on your report. But we need to do rapid rescore because we want it to reflect in the scores, right? with these sorts of companies, you could provide them the documentation and they'll zero it out, which helps your debt to income ratio, right? But it won't amend the scores. So that's why you would have to pay the $90 in order to get the score updated. Let's say the loan product they wanted needed a 700 and they only have a 696, right? Something like that. That's where you'd spend the money, okay?
I guess with getting home loans, like, do any of the home loan products use just one repository? Like when I used to sell cars, it's like,
Yeah.
hey, we can use Experian on this, and
Yeah.
we're just gonna push through on this. And so in this instance, they'd only have to use just maybe one cleaning product. So
Yeah. Yeah, it actually, unfortunately, doesn't work the same way in lending. What they'll do is the middle score.
Gotcha.
So if, in our example, moving 696 to 700 doesn't help us because the middle score is still 647.
Right.
So we could move the 647 to 700, now our middle score is 696, and we still haven't met the 700.
Right.
Does that make sense?
Yep.
So really, that's why when you do it, you really appeal it with all three, because in one score it could help you 18 points, and another one it could help you 42, and you don't know which one's going to reflect it.
Gotcha.
And that, in a way, gets back to the BU1 and BX1, because not every repository is reporting all the accounts. And so it's what else you have that affects how much fixing one thing benefits you.
Right.
And so that's why it never fixes it all the same. That's why when people tell you, oh yeah, make this change and your score will rise X, there's no way they can predict. Now, there is a website called myfico.com, and you can actually plug in, hey, what if I do this? What effect will it have on my score? And that's from Fair Isaac, so you can count on that. And that's a really good tool for a loan officer. You in your capacity as a real estate agent, you might just tell your client, hey, go to myfico.com and play with it. 'Cause
So
it'll,
MYFICO.
exactly, yeah. So if you had a customer too that was carrying around some debt but didn't have any collections or anything to wipe out, they could put into this model, oh, what if I paid off my Nordstrom card? Will my score go up? And it'll tell you. So it's a really useful tool. Really underutilized, in my opinion. All right. Okay, so now you know that it's the middle of the three scores, right? You know that the 4 characteristics are listed in the order of severity or significance, right?
Does it matter if it's the husband or wives?
In lending, like
Yeah.
underwriting, it'll be both middle scores.
Oh, okay.
Yeah, so they'll look at the lower of the two if the program has a minimum requirement. Now, you can get around that on some products because maybe the wife's a homemaker, and then they wouldn't really care about her score, they'd focus on the husband.
Okay.
So that, you start to get into product-specific underwriting, and that's not worth your or my time.
Okay.
But yeah, you want to just, in real estate, unlike your past experience, you just always want to be focused on the middle score. And you know what your score is off the top of your head. Your client may not, so just work with your loan officer. And understand this, you're not really entitled to know anything about their credit, right? And I'm not suggesting that you should wedge your way in there. I'm just suggesting that the more knowledgeable you are, the more valuable you are to your client, okay? Who wants to guess at what the number one reason that scores aren't higher than they should be or could be?
Bad information.
Okay, inaccurate?
Inaccuracy.
All right. You have a guess too?
Could you repeat the question?
What is the number one reason in the U.S. that consumers' credit scores aren't higher than they could be? Number one reason sort of weighing down their scores.
Because I don't want people to spend overspending.
So you think it's that they are overspending and that's causing it?
I think that's psychology.
Okay. How about you, Diane?
I was just gonna say late payments, I don't know.
That's usually the most common answer. Derogatory items of any
Uh-huh.
kind, right? Late payments, collections, whatever. The actual number one reason is revolving debt. And it's the number two reason in Robert Smith's TransUnion score. Proportion of balances to credit limits is too high on bank revolving or other revolving accounts.
Their credit limits are too high.
No, their balance relative to their credit limits. And I'll give some numbers so you can kind of visualize it, but that is the number one reason. And what they're saying is people use too much revolving debt. So do you guys know the difference between installment and revolving? All right, so installment is a car loan, right? I borrowed $7,000 to buy my Corolla, and I'm going to pay $150 a month until the $7,000's paid off. Revolving is my Visa. I have a $7,000 limit, and I just bought a hot tub, and now my balance is $3,500, and oh, that's a nice whatever. Oh, now it's $4,500, and then it's creeping and creeping, right? Revolving is really a good window into their character, right? Remember in the last training we talked about their character and willingness to repay? Well, if you max out all your cards all the time, it doesn't mean you're a bad character, but it does mean you probably have bad money management skills, right? And the score penalizes you for that. What a lot of people don't realize is the FICO score was invented not to predict your probability of making your mortgage payment. It was actually invented to predict bankruptcy. Very few people know that. The reason revolving debt weighs so heavily is it is the best indicator of somebody that is on the slippery slope towards bankruptcy. Because if my income shuts down, do my expenses shut down? And I can tap into my revolving card to meet my obligations. I can even use debt to pay the payment on debt. That's a really bad idea, right?
Right.
So that's why Fair Estate Company says, man, if that's an issue, we're really going to hammer the score. So what they did is they developed what's called a utilization ratio. The utilization ratio is how much you have available to you divided by how much you borrowed, right? So your balance is the numerator, and your limit is the denominator. All right?
Can you repeat
So we're gonna
union,
actually put that on the board here.
like a formulation?
Yeah. Let's make it big. All right. So it's that balance over limit, right?
Equal.
Or limits. So let's put some numbers to it to kind of crystallize it. If I have a $7,000 Visa card and my balance is $3,500, what's my utilization ratio?
50%.
50%, right? What do you think the threshold is at which it becomes a negative impact on my score? Because if my balance is $10, do you think it impacts my score negatively? What do you think that ratio, that percentage is where it becomes negative?
20.
20? What do you think, too? You think about it,
Doesn't
Diane.
it depend on your income?
Income is nowhere on this report,
Yeah.
so no, you can't factor that in. That would, in an underwriting environment, we would factor that in, but purely FICO scoring, it's actually 20%. Vernon's exactly right. So what that's saying is, in my example of the $7,000 credit line, the minute I have $1,401, it's having a negative impact on my score. Not a very big one in that example, but I get to $2,000, I get to $3,500, I get to $7,000. It's killing my score, right? Now I've had people call me that I was working with on their loan, and they said, I closed my Nordstrom account and my score went down. Why is that?
Because they needed more of a
You're
credit
not
line.
exposed to spending over your limit.
Well, they closed it though.
That means they eliminate the overspending.
If my, so now in this example, I have two cards. I have my $7,000 Visa, and I have, let's say, a $1,000 Nordstrom card, right? With a $1,000 limit. All right, so I have $4,500 total dollars as the numerator against 8,000. Let's make it 2,000 for Nordstrom. Against 9,000 for the denominator, or a 50% utilization ratio, right? And I met with my loan officer, and he said, you got to get your revolving debt down. Your scores are too low. You don't qualify. Get your debt down, and it'll help you. Did that just shut off?
Still working.
Dang.
Ding.
It's green.
So they go to Nordstrom, they write a check for $1,000, and they say, you know what, close that account. The rate's lousy, I don't want to be tempted. They took 1,000 off of the balance in this formula, but they took 2,000 off the denominator. So their ratio actually went up, right? So that's why what they should have done is paid it off but left it open. Because you want to keep it in the denominator, but this is the number you're trying to chip away at.
So the ratio lower.
Right, right. So cut up the card, just don't close the account. Now, does that mean you should never ever close a revolving account? No, but you should be cognizant of this 20% threshold and close them as long as it keeps you under that threshold. Does that make sense?
Mhm.
Now, we're talking about a pretty idealistic world. Somebody that has one card, maybe two. The reality is most consumers have 4 or 5, right? And so you would then have to add up all the balances and add up all the limits to come up with whatever their utilization ratio is. The system does it automatically. It doesn't show you what the number is, but it hits your score because of what the number is. Make sense? So let's look at these 6 scores. Back to this slide. And why don't you, Vernon, you're looking at it while I'm doing this. How many of them have that revolving issue in it?
Each of them, all 3.
All?
All 6 actually.
So number 10 is in the first one, the second one, the third one, the fourth one, the fifth one, and the sixth one. So there you go. Now let's look at some of the other ones, right? We already knew about the collection one, that's number 40. What's number 14?
Length of time the accounts have been established.
All right, you heard me say earlier the term depth of credit, right?
Right.
If Vernon's a young guy and he just got his first credit card this year, he's going to have that one show up, right? Because he hasn't demonstrated over time that he's utilized credit. If I'm a lender, do I want to be the first one to lend Vernon money?
Of course not.
Not really, right? I want to see you kind of prove it to Nordstrom first or Visa,
Right.
and then I'll start to get more comfortable. So sometimes your loan officer is going to coach your client on getting some additional trade lines just to beef up there. But you can't create or fabricate whenever you opened your first account, right? You can't create something that opened earlier than that. Simply not true. My first account on my credit report was open when I was 2 years old because I'm Ed Lane Jr. And when I first got old enough to worry about or think about these things, I pulled my credit, and I worked for a lender so I could pull my own. And I was like, Macy's, 1969?
Get that onesie.
What the heck? Yeah. So I called my dad, I'm like, you better make your payment on time or I'm coming after you, man. All right. Number 32, lack of recent installment loan information. Let's see.
Bought a car or something?
They've not had a car loan in a while.
Yeah. Nothing since, they have a mortgage, but they don't have an installment loan other than that, right? That collection, they called it an installment loan, but that's not a real installment loan. That was just a medical collection.
So if there's somebody pay off their loan and then the company that owe the money will upgrade on the system?
Yeah, yeah. Yeah, it just depends what you did, right? If you paid it off and closed it, they'll show it as closed.
Hmm.
And then that would affect your score because the denominator would have been affected, right? But they have an obligation to report information accurately. That's a federal law. So your creditors can't make stuff up or make false statements. And that's some of the ways that people get derogatory credit removed. They ask the creditor to prove that you were late. And they can't because they don't have good record keeping. And they have to remove it. That's not always true, but that's a real common approach. All right? All right, so next one down has number 20. That's a new one. Length of time since derogatory public record or collection is too short. So they're kind of double hitting that score because they have the collection reason number 40. That's a negative. And then reason number 20 is related. Hey, you got a collection, Vernon. We're going to knock you down. And it was pretty recent. We're going to knock you down more. Right? That's what they're saying. Number 14 we already talked about. 30. Time since most recent account opening is too short. It's kind of the same as number 14, right?
Quick question for you.
Yeah.
On number 20, like that double hit right there.
Yeah.
If I was to go in and let's say make that payment and pay off the collection, and got a letter from that third party, would I be able to go in, send a letter to the repository and
Rapid
say,
rescore or something?
And then that's
Absolutely.
where that would work. Okay.
Yeah.
Absolutely.
There's an interesting quirk that a lot of people mismanage, and that is, depending on the severity of the collection, what it was, how big it is, if it was from 10 years ago, and your lender isn't requiring that you pay it, you really should just leave it. Because at that point, your date of last activity is 10 years ago. The minute you pay it, your date of last activity is September of 2013. And that actually can drive your score down if it's a small enough collection. If it's big, it's killing your score. It's better to get rid of it.
How much would a collection really affect your score?
Well, you can see right here, let's look at Robert's Equifax, so the third one down.
Mm-hmm.
2 of the top 4 and number 1 overall are all related to the collection. And that happens to be his lowest of all 3 scores.
Mm-hmm.
So it's having an effect.
Mm-hmm.
And he had paid it off 2 years earlier, over 2 years. And we'll get into how to read that. But keep in mind, this report we're looking at was pulled September 11th of 09. So that's sort of the relative age of all the stuff we're going to look at. Okay? And then look at the bottom of that credit scoring section. It says FACTA. What's it say next to that?
Too many inquiries last 12 months.
Yeah. How many of you have heard that? Hey,
Heard it.
you're going to pull my credit? Is that going to
Yeah.
hurt my score? Right? So let me hear your understanding of whether inquiries hurt your score. Anyone want to volunteer?
I had the one client who didn't want to be pre-approved because it was going to affect their score
Okay.
until they found the correct house.
Okay. Are they going to use cash to buy it?
No,
That's problematic.
yeah.
And we'll get into that. But before we do that, how about you guys? What's your perception of inquiries and their impact on your score? No impression at all?
No, my impression is that if they're, one of the things I've heard is that if they're done in a certain time period, like, again, former industry said if you had so many done in the 30-day period, I guess there would be people who gave windows for that because they'd be shopping products. And so instead of doing, like, I don't know how it works in lending, but...
We'll talk about that. It works the same,
Okay.
right? Because you're pulling a credit report just like we are.
Right.
You're pulling it for different reasons,
Right.
but it's the same FICO score,
Right.
right? So we'll talk about my first question, then we'll talk about yours, because that is absolutely one of the things I want to make sure we cover today.
Okay.
So an inquiry will impact your score between 6 and 12 points. Depends on what your profile looks like, but that's basically the impact. All right? So my score might be 800, but when I get my credit pulled, it's going to be 788. Right? Vernon?
Now, hard and soft, like we talked about last week. Now, is that only for hard inquiries or
Hard inquiry.
for? Okay,
Yeah.
gotcha.
Yeah. Soft inquiries, just to cover that again real quickly, is if a creditor has already extended you credit, they have the right to look and see what your credit is like down the road. That's a soft inquiry, does not bring down your score. Okay? A hard inquiry is somebody that's entertaining extending new credit. Okay? So it affects your score 6 to 12 points. Diane's client doesn't want anyone to look at their credit until they found a house. What's one of the basic rules of being a real estate agent and showing properties? You don't show unless they're pre-approved, right? Or maybe you show once, but then you gotta push. So that individual just needs to be educated. They don't need to be persuaded or pushed. They just don't understand. They think they do though, right?
Mhm.
They think they know more than they do. The reality is you can't borrow money without proving that you're going to repay it, i.e. your credit, right? The 3 C's that we talked about last time, credit's a big piece of that. This person wants to buy a house and they want to use other people's money to do it. Guess what? You're going to have to show other people your credit. Now, if you would like to look around at houses before you make application, that is a fatal mistake, plain and simple. Because a seller isn't going to consider you a bona fide buyer if you're not even willing to get pre-approved. Now I know, Joe, your worry is that your score is going to get pounded downward by virtue of this pre-approval, but here's the good news. They're going to pull your credit and you're going to get pre-approved. That pre-approval is good for 90 days. An inquiry only weighs on your score for 90 days. So let's go ahead and get you pre-approved so we can make sure we're really a candidate to buy that home. And also, if you wanted to shop multiple places, this ties into Vernon's comment, inquiries within a 2-week window, not 30 days, but 2 weeks, that are from like creditors get counted as one. So Vernon could go to B of A and then go to Wells Fargo and then go to Academy Mortgage, and all 3 of those would show up, but his score would only have been affected by 6 to 12 points. So there's no reason to wait because you don't know what you qualified for. You might think you do, but you don't, right?
So that means they can inquire in 3 different mortgage companies within 2 weeks period, and it's effective in one time.
Right.
6 to 12% effective.
Not percent, points.
6 to 12 point.
Yeah,
Okay, got it.
yeah. That's a big distinction because if your score is 700, you're only going to drop to 694 or 688, somewhere in between. Okay?
Now, when you said weighs on it for 90 days, does it go back up?
Yeah, it goes back up. The inquiry will still show, but it's no longer an impact on your
Okay.
score. That's the irony, and that's why I kind of giggle
Yeah.
when I run into people like Diane's client. None of us will ever see our score at its actual highest point because you have to have an inquiry
Yeah,
to
so
see it,
lowers it.
right? So it's, if you're 6 points away from qualifying and you think pulling your credit is going to make it so you don't qualify, you shouldn't buy, right? It means you don't qualify, right?
So that was gonna kind of leads into a question I had. So
Sure.
once a person does do that first one, there is that 6 to 12 point hit. Let's say they are 700.
Okay.
Does it read them at 700 or does it read them at 788 or 688?
688.
Reads them at the 678 after that pull's been done.
Yeah,
Gotcha.
yeah. Yeah, because the system is going, oh, they're applying for credit.
Oh,
There's a cost for that, right?
Right, gotcha.
Because that could mean they're on the slippery slope towards bankruptcy.
Right, gotcha.
But the system's also sophisticated enough to go, well, a prudent consumer is going to talk to more than one place,
Right.
and we should not penalize them for that.
Right.
So that's why it lumps them. But if you get pre-approved on the 1st of the month, and then again on the 20th, and then in October, those are all going to be unique inquiries that'll hurt your score. So you just want to be smart about it. And that's where you become a resource to your client when you say, hey, I understand your concern and you want to make sure you get the best rates. Do it, man. Just make sure you do it within a 2-week window. I'm looking out for your best interest.
What do they consider too many inquiries in the last 12 months? What do you think?
Is that too vague?
Yes.
Yeah, it's deliberately vague. It's relative, right? So let's look and see how many inquiries they had.
Oh,
There's only one, and it's this one. So they're not even showing the other inquiries. That's pretty funny. In my experience, you wouldn't get that FACTA code
uh-huh.
if you really had. Does everyone see where I'm looking at? On page 2, the third bar from the bottom is inquiry information. September 11th, 2009, ABC. Right, ABC Company is the name of the mortgage company that pulled this credit.
Which one? On the page 2?
On the second page, the third gray bar from the bottom
Next page.
says inquiry information.
Next
Mhm.
page is it?
Sorry, the third page. It's
Oh,
the second page of the report.
Mm,
You see where it says 9/11/09? Down there? Down the bottom. Third gray bar from the bottom.
So
See September 11th, 2009?
Yeah. So, it's right
Thank you, Vernon.
Okay, got it.
Yeah.
here. Oh, you have,
Yeah.
okay, all right.
Diane's eyes were like up near the top of the page. I'm like,
Oh, I was looking over their late payments or their
Yeah.
other things.
okay.
See if they had anything else.
All right, so let's talk trade lines. All right, so the next section is entitled Credit History. Right? So you can see what I'm talking about when I say it truncates terms and words and labels, right? It's easy to know that that first trade line is Wells Fargo Home Mortgage, but it still truncated it. Right? Now every trade line is going to have these same data points, these same boxes. So you got the open date, the reported date, high balance, months reviewed, 30, 60, 90-day lates, last active, which repositories were pulled, high credit limit, what type of loan it is, and then past due amount, payment, and current balance. That'll be on every single one, so let's go through them. All right. So the open date, that's easy, right? This loan is 2 years old, right? 2 years and 2 months. Reported date. So what that's telling us is, when was it last reported? Well, it's last reported this month. There are some creditors that aren't as diligent about how often they update the repositories. So if I'm an underwriter and the last reported date was from 6 months ago, I have to ask for proof that the payments were made since the last reported date. What's the easiest way to get that, do you think? Let's say the last reported date for this Wells Fargo home mortgage was March of '09. How can I get the comfort that they've made all the payments since March on time?
You just have to go to Wells
Go
Fargo.
to Wells Fargo.
Go to Wells Fargo, get like a statement or a record of the account? Sure. Could I also
That's
call,
asking.
what's that?
Could you ask them personally?
The
record?
consumer?
Yeah.
You could, the only thing they could provide you that would be acceptable would be canceled checks front and back. Because I could show
Which
you a
has
bunch of
that.
checks dated March 1st, April
Mhm.
1st, et cetera, and I wrote them last night,
Mm-hmm.
right? So canceled checks front and back, and I would look at when they cleared the bank
Mhm.
to know that they were paid on time, right? Couldn't I call factual data and say, hey dude,
Updated.
update it?
Right.
All I need is a new report that shows
Mhm.
9 of 09.
Right.
That's the easiest way. These other ways would absolutely work if this wasn't available, right? Because this is the easiest, okay? High balance, so that's the original loan amount. If it were a revolving account, that would be whatever amount it ever got up to. So we're gonna pick on Vernon. Vernon has a $5,000 Visa card, and at one time, back a long time ago, he actually was over his limit by $100. His high balance would say $5,100, even though the current balance might be $400 or whatever, because he's now much more responsible, right? So in the case of a mortgage, it's just whatever the original note amount was, in this case, $160. All right? Months reviewed. So we have 23 months reviewed on an account that's been open for 26 months. Should we be worried?
Does it change between a home loan and a revolving loan? Like, is that a different?
How many months reviewed?
Yeah. Like,
No, not really. What's in my head that I'm waiting to see if anyone guesses it,
I don't get
would
the
be the same.
question.
What's that?
I don't get the question you asked.
Well,
So
with
you see-
mortgage, don't you usually not pay right away?
Ah, you're on the right track. Yeah, absolutely. So the question two was, this loan opened in July of 09, or July of 07. It's now September 09. That means the loan's been open for 2 years and 2 months,
Mhm.
26 months. Months reviewed only shows 23 though, and my question was, should we be worried about that? Diane nailed it. So September's payment isn't late. Can't be. We're still in September, right? So that's one of the 26 months that wouldn't be reflected.
And is it usually like 45 days or something?
It's a
to-
minimum of 30,
Okay.
and it's usually more like 45. So if we closed in July, we won't have an August 1st payment. Our first payment would be September 1st. So now, September 1 of 07 to September of 09 would be 24 months, and maybe they hadn't made this month's payment yet because it's only the 11th when this was pulled. Now we're at 23. So it actually reconciles perfectly, right? If it didn't, let's say it said 22 months, as an underwriter, I would just go, all right, well, if you're telling me it's never been late, I'm good with that. Now, if it were only 16 months or something like that, then I'd say, hey, I'd call factual data again and say, hey, fill in the gaps. Or give me they can give you a code that is a series of letters and or numbers that tells you by month how it was paid. And each company does it a little bit differently, but if they're all ones, one means current. Some companies put a C. But you can actually look at this series of ones, and if there's a 2 in the middle, you could go, okay, well, this report's September of 09. That means the first one is September 09, August, July, and you count backwards and go, okay, the 2 means they were 30 days late in December of 08, or whatever you counted back to. So that's all important for an underwriter because they have loan products that say, you can give this person this loan amount as long as they've not been late on their mortgage in the last 12 months. Well, if that 2 was in August of 08, we're golden. If it was in October of 08, we're screwed, right? So that's why they might ask for that. All right, 30, 60, 90 boxes, those would just be totals. If you had a bunch of lates, it would say 2 times 30, 4 times 60, 0 90s, or whatever. Okay, so we just total them up. Last active, that's where they're saying, hey, this is reporting up through right now. Okay. Now, in the BX1, CX1, BU1, CU1, BQ1, CQ1. Is that all 6?
Mhm.
Yes. If any were missing, I might, as an underwriter, go, well, I want to make sure the missing ones aren't reporting any lates too. It's really more than likely that they aren't, but that could be a concern. High limit is blank because this is not a revolving account. All right? It is an installment account. Oh, I skipped over it. In that box where BX1, CX1 is, see where it says joint?
Yeah.
Mm-hmm.
That's an ECOA code. And that just tells you that it's a borrower, co-borrower situation, right? If you look down, you'll see under that next card, it says IND. And look at the codes, CX1, CU1, CQ1. Whose name do you think that one's under?
Barbara K.
Right, co-borrower, right?
Right.
So this is what I was talking about earlier. When you have derogatory stuff, you want to know who to get after.
Right.
So you go to Barbara and say, hey, your Citibank card is showing some lates. What's the story there? I was never late. They misapplied it. Here's the documentation. Great. Okay? So back to the home mortgage. 180 times $1,523. That's what it says in the payment. What does the 180 mean?
Sub-payment number.
Total payments, yeah. It's a 15-year mortgage. A 30-year mortgage would be 360 payments, so this is a 15-year mortgage. And that also makes sense, because when I first looked at it, I was like, wow, a $160,000 mortgage in just 2 years dropped to $146? That's some serious principal reduction. That means they probably were making extra payments. Now that we realize it's a 15-year loan, that makes more sense.
Right.
Okay? Why do you think it says Freddie Mac in that little box at the bottom of that trade line?
Is that the loan is from Freddie Mac?
That's the investor on that deal, yeah. Yeah. So Wells Fargo is servicing it still, but they sold the loan to Freddie. Okay? Next one is Universal Card. So that's a revolving card. So we're going to see some different data. All right, opened in March of 2000, reported as of right now, right? High balance, 19,734. Look right below that. What's the limit on that card?
27.5.
So they've never maxed the card out. The highest it's ever been is 19,734. What's the current balance?
19,734.
So it's at its highest peak
Right.
today,
Mhm.
right?
Yeah.
And if we use our utilization ratio, that one card is at almost 70% or something like that, right?
Right.
So their score is being impacted. That's why, remember up above, we saw that revolving credit reference,
Right.
right? Now we know why. We also have, if we look at the next card, a $25,000 Chase card with a 12,442 balance. So that card's at 50%, give or take, and the Citi card is at 70%, so they're kind of in between. Right? What is that? 31,000 between two cards that are almost a little over 50. And then you have a third card with a $10,000 limit that's at 90%. The Wachovia one, right?
That's just about at 100%.
Yeah. Yeah, within a couple $100 of it,
there's-
right?
Yeah.
So now you understand why you would actually take all three credit limits, add those up, all three current balances, add those up, and then divide them. And now you know their utilization ratio.
Right.
And now you know why these scores are being impacted by the revolving use.
So what if somebody have a bad habit spending and they try to fix the credit in
Mhm.
order to get a good score?
Yep.
How soon it will show on the report?
So the creditors batch their data, because Citibank has lots of people with Citi cards, right? they batch that data up to the repositories once a month. It depends on what time of the month they do it. Because Citi might do it on the 10th and B of A might do it on the 30th. It just all depends.
You do once a month.
Yeah, so what you would coach your client on is, hey, if that's your plan and we want to buy in the spring, you should start working on it now and really set a goal to have it kind of wrapped up by January. That way there's enough time before March for your credit to get updated. That's a different discussion than the, oh man, we got to hustle, let's get a rapid rescore done, right?
Mm-hmm.
Rapid rescore is when you're already under contract and you've got a limited time frame to do stuff. If people are building towards and working towards home ownership, it's not an event, right? It's a process. That's why I talk to people all the time. And one of the things I always say, and I think I've said it in this room before, is, hey man, it's never too early to figure out where you are right now so that you can figure out what you need to do in order to get where you want to go. We should get you pre-approved today. And if the pre-approval says you're not ready to buy for 2 more years, big deal. Now we know. We know what we got to work on. We know not to get all excited about being in a house by Christmas, because that's just going to be depressing, right? Most of them it's not 2 years. Most of them it's ready to go now, but maybe not buy as much as they want. Well, that still gives you info, right? That still gives you a plan. Hey, let's go see if 180 gets you a neighborhood in a school district that you'd be interested in. And if the answer is no, now we know what we need to do in order to get the pre-approval up to 250 where you really want to live. That means consolidate these debts, right, to get your debt to income up, or start getting some overtime if you can. You know, it's harder for people to generate more income than it is for them to reduce their expenses. Right? You can take action to reduce your expenses. You got to get your employer to cooperate to raise your income, unless you're in commission sales like us, right? All right. So the last thing, and I think I'm going to skip the factual data presentation because the interaction here has been way better than I feared. So I hope you guys are getting a lot out of this.
Yes.
But let's look at this credit collection.
What page?
We're at the bottom of that same first part of the credit report.
Okay.
All right. So you see where it says MediCredit, the last trade line.
Mm-hmm.
This one right here, MediCredit. Opened in November of 06, reported in June of 07 for $400. All right. What does it say under the payment box in the gray?
Collection 207
Paid.
paid.
Yeah. So it went to collection in November and they paid it by February. But they didn't report it till June. That kind of sucks.
Who did not report it? The credit
The
company?
collection company.
Hmm.
And they're saying the date of last activity was May. That's BS,
Whole month.
right?
That's a place where you could challenge, right?
Absolutely.
Like a month.
So let me go through again. Opened in November 06. So that's when they went to the hospital in the summertime. The hospital tried to get them to pay the $250 bill. And the insurance, they said, oh, my insurance is going to take care of it. Insurance never did. They sent it to collection in November. The hospital did. So that's when MediCredit got involved. They get a letter in the mail in November that says you've been sent to collection for $397. And they go, oh crap, let's pay that. But it takes them a couple months to assemble the $400, so they pay it in February. It's closed at that point. That's the date of last activity. But MediCredit, like most collection agencies, is not very good. And yes, I know this is being recorded. I'm not a fan of collection agencies.
But
And it's because they use kind of scummy tactics and they don't keep good records and they don't update stuff the way they're supposed to. So they took 3 months to tell the repositories that that collection was paid, and they are negatively impacting the Smith's score because of the recency of the collection. And it's 3 months more recent than it should be. So that's what Vernon was noting, hey, they should be able to challenge that, and the answer is absolutely, right? So you can see below the explanation of what it is, Spartanburg Regional Medical Center, right? Paid collection, unpaid medical something. That's a pretty common thing. In fact, some underwriters don't give medical collections any weight at all. It's gotten now to the point where the score is everything, so they don't even really review credit as tightly, but there's a few creditors that people don't worry about. Sears is another one, because Sears will say, let's say Vernon has a Sears card, and he buys a new fishing pole, a nice one, for $300. And he gets his bill and it says your monthly payment is $10. And he goes, well, I'm not going to just pay this $10 at a time. Writes a check for $50 because he wants to make some progress on the balance. The following month, Sears will send Vernon an updated statement. It shows that he made a $50 payment, and it'll show that his payment that's due for this month is $0 because he made more than a double payment last month. If Vernon actually doesn't send any money in, they're going to report him late.
Wow.
Yeah, and that's BS, right?
Right.
But that's how they do it, and that's why no one gives any credibility to Sears Roebuck. Now, if you had 60s and 90s and that kind of stuff, then that would get attention, but not 30s because they're goofy. Medical collections are commonly given less weight because so often all of us, right, have health care of some sort, hopefully, and you trust that the insurance company is going to handle it. And you get a bill that shows $1,200, you're like, holy cow, I think my piece of that is only $200 or something. I'm going to wait until they get the $1,000 from the insurance company. Well, insurance companies aren't the fastest payers either. And if the hospital's aggressive, they'll send you to collection. So, anyway, that's where interpretation can come in.
This really helped to understand and
Yeah?
guideline client.
Good. The last parts you can read through at your leisure. They really are, they're intended to be used to help you interpret credit. That whole summary information box, nobody really uses that, right? I mean, it says oldest trade line, open revolving payments, open installment payments, etc. Underwriting does their own math, right? They don't lean on this aggregation for anything.
When you say underwriter do their own math, is there a guideline for each bank?
Not each bank, but there's common practices. And what the common practices are, they pull a credit report and they import that into their processing software, like the application form we talked about a couple weeks ago.
Mm-hmm.
Those liabilities, these liabilities, would pull right into that section of the application, including the monthly payments. Now, if there's an account that doesn't show a monthly payment on it, I don't know if this has any, they all do, then they would have a practice of applying a payment. And for revolving, they use 5%. So if you have a $7,000 balance, that's a $350 payment. If you've ever had a Capital One card, you know that that payment actually is more like $70 because they want you to have a balance forever, right? But the underwriter will apply 5% unless your client provides proof that the payment is something different. So you can provide your Capital One statement and go, yeah, no, my debt to income is lower because this payment's not $350, it's $70. Okay? I think you can see where they've done name checks, looking for file variations, also known as checks. All right, Robert Allen Smith, Bob Allen Smith, and then the contact information for the repositories. And that's it. Now, this is probably the shortest report I've seen in a long, long time. Most people have many more accounts than that. And really, in my experience, the more raw the data, the better, because it's easier to read. But if you went to freecreditreport.com, you get a 17-page report, and it's all pretty and formatted, and there's way more text. I'm more of a data guy. I can count 30s, 60s, and 90s. I can read credit scores and their factors. But it doesn't mean you shouldn't pull your credit once a year and know what's on it.
I see a lot, I always saw they offer free credit score, but I didn't dare to apply for it.
Yeah.
They asked me so many questions.
Well, they need everything on that first page, right? Your social security number, your address, date of birth,
I never.
full name.
Is that safe?
Yeah, yeah. Freecreditreport.com is legit. You can actually, what I tell people is you don't need to go there because they won't give you a FICO score unless you pay for it. So it's a misnomer to say free credit report if you're not going to give a credit score, in my opinion. But you can go to Experian, Equifax, and TransUnion, and they're required by law to give you your report for free every year. So you can get yours there.